Hello and welcome to this Thursday's morning market briefing. We've got lots to talk about, but firstly, the Federal Reserve Chair Jerome Powell does signal interest rates will remain higher for longer, as well as that the US includes Chinese groups in sanctions over aid to the Russian military. We've got lots to talk about in the charts. Also, with lots happening on the economic calendar, we'll come to that near the end, so make sure you stay around so you can see that. Before we get straight into it though, make sure you subscribe. The first article to talk about is to do with Jerome Powell and the Federal Reserve. Now, the Fed Chair, Jerome Powell, has now signalled that rates will stay higher for longer. This comes as the Fed continues to battle with persistent inflation, which has now been facing the US economy for a couple of years. Now, of course, this is a very important topic and a very useful article on the topic, which of course does cover the recent Federal Reserve interest rate decision and the following press conference, which did of course happen yesterday. Now, this was a meeting and a decision which of course we were looking forward to the entire week, whilst we were of course expecting interest rates to stay the same as everyone else in the market was expecting. Ultimately, we were really waiting to listen out for what Jerome Powell and the rest of the Federal Reserve was to say following the decision on where inflation is heading and where interest rates could go over the coming year. We know, of course, that at the start of this year, interest rates were being expected by the Fed to be cut at least 3 times by 0.25 percentage point levels. So, cutting them by 0.25% each time. And ultimately, though, that does not seem like that will be the case for this year. Ultimately, because we just are not seeing inflation really move down to those levels which the Fed would be happy cutting interest rates at. Ultimately, what the Federal Reserve has been saying throughout the past year or year and a half, let's say, is really that they're looking to only start cutting rates or only start thinking about cutting rates once inflation really is nearing that 2% goal. And whilst inflation is currently in the US around that 3% level, so not far off, ultimately the way inflation is presenting itself is it's still seemingly very, very persistent. It's not budging, it's not moving to the downside, most certainly. And so it's very hard for the Fed to then reassure the public, reassure the markets that interest rates will be cut in as fast a period as was previously expected. As whilst the Fed was expecting 3 rate cuts this year, markets were expecting as much as 6 or 7 interest rate cuts, beginning even as early as March. And of course we know that can't be the case now that we're in April going into May. Actually, it is now May, pardon me. But ultimately, we know that that can't be the case, but that was certainly what markets were expecting. And we do know now, at least before this meeting took place, before this interest rate decision, that markets had now priced down the number of rate cuts this year to just 1 rate cut, which is a large change from the start of the year, of course. And this change has been very dramatic, and you can just see that change in the markets, of course, as we will get to in the chart section later in this video. But ultimately, this change from the Federal Reserve, this change in rhetoric was quite quick and took markets by surprisingly, just following a great deal of US economic data presenting that the US economy was still strong and inflation wasn't coming down. And what we're hearing from the Fed, as I've just said, is that they don't see inflation coming down soon anyway. So ultimately, the markets are now forced into this position where they're having to now reprice in numerous different US related assets to their correct market value, as previously these assets were either inflated or lost a great deal of value when people started to price in those rate cuts. We knew this was certainly the case with the US equities market, with seeing a large rally taking place when markets were expecting lots of rate cuts this year. End of last year, start of this year, we were seeing that large market rally take place within those key US indices such as the US 500, the S&P 500, the Nasdaq, and the Dow Jones, we were seeing all those markets really push to the upside. Meanwhile, of course, we were seeing the dollar sell off greatly. Of course, now that we've seen this change in rhetoric, we're seeing that reverse. We're seeing markets sell off with regards to US equities, and of course, we're seeing the dollar find a great deal of bullish momentum, as now the Fed is seemingly going to be the last central bank out of these kind of key central banks that we talk of, such as the Bank of Japan, ECB, and Bank of England. We're now expecting the Fed to be the last to cut interest rates out of all of them. And if we think back to the start of this year, we were really thinking about the Fed even possibly being the first to cut interest rates alongside the ECB, of course. So most certainly this is a very important article on a very important topic. It's something that we cover all the time, but of course this is kind of the thing that we're always looking to read about and learn more about, as this is really what affects the markets most greatly. So of course, that is the current situation at the moment, with the FOMC reporting that there has been a lack of any progress towards the key 2% inflation target over recent months. And of course, that's the inflation target, where should inflation make its way down to those levels, that's when the Fed will start to then really consider cutting interest rates. Now, this rhetoric from the Fed solidifies the outlook of many traders, which is that there will be no rate cuts from the Fed until the second half of the year at the earliest. Despite this, however, the Fed repeated its previous comments that they were still not interested in raising rates any further in an effort to finally bring down inflation. The Fed, as expected, kept interest rates at their current 23-year high, which has now been the case since the summer of 2023. The hawkish outlook on inflation from the Fed is largely the result of recent economic data from the US, continuing to show that the US economy is still strong and inflation is growing just slightly. This statement and decision from the Fed will also not bode well for the current US President Joe Biden, as he does go head-to-head with Trump in the November election. The only upside or positive to the press conference following the rate decision was that Powell insisted that the economy was at least strong and inflation was under 3%. The Fed had ultimately hoped to have cut rates 3 times this year, but now this seems unlikely. So, a very interesting article here on this very important topic, which of course we were looking forward to. And make sure you keep your eyes on anything else to do with the Fed, as we will likely now see a few Fed related speeches also take place the rest of this week, and so there we can start to gain a grasp of what other officials are thinking. And of course, most importantly, tomorrow, so on Friday, we are receiving the US NFP figure, which of course has a monumental impact on the way markets perceive the Fed will proceed with monetary policy. So lots to think about there and lots to look forward to. Next article to talk about, though, is to do with the US sanctions with regards to China and Russia and their military, or at least Russia's military campaign in Ukraine. Now, the US has now imposed over 300 sanctions on Russian and international entities. These entities include some also from China and Turkey, which have been supporting Russia's military efforts in Ukraine. Pardon me. Now, whilst we may not always talk about sanctions because they're not always happening, ultimately we've been covering international conflicts greatly, and of course we've also been covering US and Chinese as well as US and Russian relations to a great extent, and we do know of course that both of those relations are really at their all-time lows. Maybe not China at the moment, just because of certain efforts to kind of re-establish those ties, but we still know of course that the US is looking to ban TikTok in the US should it not come under US rule basically. And we also know that the US is continually looking for new ways to kind of sanction certain Chinese companies, or at least reduce exports to those companies, especially to do with anything military related or electronics or AI related. So that has kind of been the situation for quite some months now, or quite some years since the Russian invasion into Ukraine, or at least Trump's presidency. So most certainly, we're in heightened tensions and low kind of communication, a lack of communications between these nations, and very low relations. But ultimately, Here we are talking about the US sanctioning Russian aid to the Russian military. And why this is kind of important is, of course, the US has announced their own Ukraine package very recently to do with, supporting the Ukrainian effort in their defense against Russian aggression into their territory. And this is including, of course, billions of dollars of US military aid, resupply of important shells and ammunition, as well as certain equipment as well, which will be sent over to Ukraine or is already in the process of being moved into Ukraine, just to do with where that equipment was already stored. So that is kind of the situation of current, and why that's important to understand with regards to this article is, of course, this move to sanction these companies which is supporting Russia's kind of invasion. It's kind of interesting that it's coming at this time just after the US announces their own aid package. So seemingly, whilst the US Congress has been quite divided over the issue over recent months, now that the US Congress have kind of come together a bit more and agreed on this bipartisan deal or bipartisan aid package, now the US is ready to once again step in and start sanctioning these companies or organizations which are supporting this Russian invasion into Ukraine. With these new sanctions continuing to reflect the US's growing concern, over Chinese and other nations' support of Russia's military campaign as the front lines in Ukraine heat up. The two key parts of the new sanctions include two Chinese groups which have been providing ingredients for gunpowder and rocket propellant to Russia. In addition to these sanctions, the US Secretary of State Antony Blinken has continued to warn any foreign company aiding Russia that they will face serious consequences. These concerns were also raised to Chinese officials during a recent trip to China by Blinken, with US officials now even considering sanctioning Chinese banks. Other companies have also been sanctioned which produce military electronics. Now, that's all to talk about on this article. Make sure you keep your eyes on anything to do with world tensions, though, of course, and especially anything to do with US sanctions or US relations with China or Russia, as that is also affecting markets greatly. That's all to talk about on the articles, though. Next to talk about, of course, is the charts, where a great deal has happened over yesterday just as a result of that Federal Reserve interest rate decision and their press conference, which of course followed. Now, we are talking about that meeting and interest rate decision since the start of the week, which of course kind of played into our outlooks to do with the charts. And ultimately, what we have seen now on the US 30 over yesterday is price spiking up to the downside and coming down quite quickly. Just that is kind of representing the volatility within the markets. But also what's interesting to see is that whilst we have seen that volatility, whilst we have seen those moves, prices really stayed at the levels which it started off the day at. And so what that tells us really is that ultimately, markets are still pricing in the same things that markets were pricing in before the meeting itself. So seemingly, during the meeting or during the interest rate decision or during, the press conference, seemingly markets began to believe that, of course, the Federal Reserve would actually cut interest rates before the previously expected, but now that we've kind of had that meeting, we've had those comments reaffirmed by Jerome Powell that basically they're looking to keep rates higher for longer. Just as we heard from the last meeting, markets have priced in the US 30 at the levels which the meetings kind of started at. So I think that's kind of an interesting point to note, as of course over the past week, price really went from this kind of top area of liquidity to this lower area of liquidity, of course, between this range. And what will be interesting to see now is whether, because we have the NFP figure at the end of this week and we haven't really gained anything new from the Federal Reserve's interest rate decision, whether price will now just kind of stagnate, consolidate and wait for that NFP figure to come out before then price is able to break out of this range either to the upside or downside. So that's really the key thing to think about at the moment to do with the US 30, the Dow Jones, and that's the current situation. So lots to think about for the US 30, especially with such data coming out this week, such as the NFP figure. Next to talk about though is of course the dollar. So something that was also greatly affected by the Federal Reserve's interest rate decision yesterday and their meeting which followed. And here, of course, we can see that price actually did sell off during the meeting and did kind of end a bit lower following the decision. Price hasn't really ended much lower, just considering the fact that price is now just back at the same levels that we were seeing on Tuesday. So really, we haven't seen much moves take place on the dollar. But nonetheless, price did spike to the downside. Price did interact with that lower level of liquidity, that area of bullish liquidity, where a great deal of buy orders seemingly have been filled, and prices then swung to the upside once again. But just as I said on the US 30, the question will be, of course, whether over this week price will now kind of stagnate, or at least today price will stagnate until we see that NFP figure tomorrow on Friday. So I think just like on the US 30, that's the key thing to be thinking about. Next to talk about though is Euro USD, which just mirroring the dollar, of course, being the inverse of the dollar at the moment. We haven't really seen too much take place apart from a slight move to the upside, but once again, just as we saw on the dollar, Euro USD has stayed within that range, that price action range, and has not broken out to the upside despite wicking into that top level of liquidity. So once again, very important things very important data which will be coming out this week. And even today, I mean, we're receiving certain Eurozone manufacturing figures and that kind of thing, but really nothing of a great significance. So I'm definitely thinking that today will be a day of consolidation for euro or dollar, whilst we do wait for that kind of key NFP figure to be released tomorrow. Next to talk about though is pound yen, which has just experienced such a great deal of such a great deal of volatility yesterday and the day before that, and even last week, with price just shooting to the upside, now shooting to the downside, and now shooting to the downside once again, with price even coming as low yesterday as what we saw on the 23rd of April before we had this large bullish rally over that entire week. So price is extremely volatile at the moment, and of course is quite a scary asset to kind of even look at or get involved with, just because traditionally we actually do look at pound yen as kind of this very clean moving pair, where we do see price interacting with these key areas of liquidity, its support and resistance, reacting to those levels and moving accordingly. Whereas over the past week or so, price has certainly not respected these key levels and instead has kind of swung to the upside, swung to the downside, as a result of a great deal of fundamental news and data coming out with regards to the yen and that kind of thing. So lots to think about on pound yen, but certainly maybe this is the one to stay away from just for the moment. Next to talk about is Bitcoin, which has just dropped below that $60,000 Bitcoin level, which of course was a very significant level, marking the kind of bottom of the market for Bitcoin. But as I mentioned in yesterday's market briefing, ultimately I said, should the Federal Reserve's interest rate position stay the same, should their outlook on inflation stay the same as it was last meeting, ultimately we're likely to see Bitcoin just breach below that $60,000 Bitcoin mark, just because that change in rhetoric from the Fed, that movement to a more hawkish position, really is what has created this kind of retracement on Bitcoin itself. So any kind of any bearish sentiment that the Fed is pushing towards Bitcoin or any other safe haven asset, of course, will weigh to the downside. Will weigh that asset to the downside. Pardon me, and that is why we have now seen price move to the downside and even near that $56,000 a Bitcoin level. Of course, it will be interesting to see whether today Bitcoin will move back and hook back to this $60,000 a Bitcoin mark before continuing lower, or in fact is this just a false breakout to gain liquidity, and will price then just increase back into this area just above $60,000 a Bitcoin. So definitely keep your eyes on Bitcoin. Next talk about though is gold, which following the meeting, price has risen to the upside. That's obviously also following price bouncing off this 50% Fibonacci retracement level. Why price has moved to the upside? Well, arguably you could just say that this is because the Fed is still very pessimistic about inflation. So whilst they are planning on keeping interest rates higher for longer, which should be create a great deal of bearish momentum for gold, ultimately, just because they're saying that inflation is persistent, that is also kind of a positive for gold, of course, as gold does act as this safe haven asset. So it will be interesting to see now that price has interacted with this 50% Fibonacci retracement level, where the price will now just continue to rally to the upside. Lastly to talk about, of course, though, is oil, which is now pushed even lower and is now back down to levels not seen since mid-March, with price breaching below this kind of weak liquidity level, as we had noted previously, and is now continuing to push lower. So it'll be interesting to see how low Bitcoin will go before then retracing. That's all to talk about on the charts. So lastly to talk about, of course, is the economic calendar, where, to be honest, we're not getting a great deal of data today. Now, firstly, we will be, of course, getting the Bank of Japan monetary policy meeting minutes, followed by the Aussie Bank of Trade figure. Followed by that, we're getting the Bank of Canada's governor's speech, as well as the Japanese consumer confidence figure. As well as that, we're getting the Swiss inflation rate and retail sales figure, as well as the Eurozone, German, French, Italian, Swiss, and Spanish manufacturing figure, as well as the Canadian balance of trade figure, and finally the US balance of trade figure and jobless claims figure. That's all to talk about in the economic calendar, though. We've got lots in the articles, lots in the charts, and lots in the economic calendar. We've got hope you have a great trading day, but that's all from us at Wildwood Capital. Have a great one. See you later. Bye.